We are exactly 15 minutes past the closing bell for Thursday, May 28, 2026. The S&P 500 closed up 0.6% to a fresh all-time high of 7,563.63.
A completely staggering closing print, honestly.
Yeah, it really is. And the Nasdaq surged 0.9% to set its own record close at 26,968.47.
Right, while the Dow, it lagged a bit but still ended in the green, up just 0.05% to 50,668.97.
Exactly. But looking at our stack of institutional market summaries and the volume verifications today,
The internals are just a mess.
right. The mission for this deep dive is to unpack exactly why the market hit these records. Because, honestly, it feels like my car when the check engine light is blinking, the engine is rattling, but we're somehow doing 80 miles an hour down the highway.
That is the perfect analogy for this tape. Everything looks great on the dashboard, but underneath, things are making some really weird noises.
So we need to figure out if this key reversal is built on a solid foundation or if it's just, a fragile house of cards.
Well, it's the defining question of the quarter, right? Because today's data presents this fascinating contradiction between the headline numbers and the actual underlying market health.
It's a total Jekyll and Hyde trading day. I mean, to understand these afternoon records, we have to rewind to the morning panic.
Yeah, the opening prints were incredibly ugly.
Deep in the red, we had April's core PCE inflation data print at 8:30 a.m., and it came in hot at 3.3% year over year.
Right, with some of the submetrics actually hitting 3.8%, which is undeniably sticky inflation.
Add to that the overnight U.S. Iran military skirmishes, and we saw WTI crude oil spike immediately to $92.50.
Or which is the mathematically correct reaction, Sticky inflation forces the Fed to keep the cost of capital high.
Right.
And you combine that with an energy shock pushing crude above $92, equity multiples are supposed to contract.
But that's exactly where I'm getting hung up on this narrative. If inflation is sticky, why did the Nasdaq ramp straight into the 4.0 p.m. bell?
Because of the midday pivot. An Axios report surfaced about a tentative 60-day U.S. Iran ceasefire draft.
Right, a draft. And we should be clear here, strictly factually, this is just a draft awaiting approval from Donald Trump and Ali Khamenei.
Exactly. It is not signed. But the moment that headline dropped, natural language processing algorithms just instantly repriced the tape.
Because WTI plunged to $88.90, right? The geopolitical risk premium basically vanished.
Exactly. The algorithms immediately bought the dip. They stripped out that specific downside tail risk, which caused a mechanical unwinding of hedges.
So institutions aren't buying the reality of a good economy. They're just riding a temporary algorithmic relief rally.
That's exactly it. The removal of the headline risk completely masked the underlying macroeconomic rot, like that 3.3% PCE print.
Wow. Okay, so if we look under the hood, that explains why the volume confirmation just wasn't there today.
Right, volume was incredibly thin and localized. It was not a broad institutional sweep by the real money.
Yeah, the breadth is actively cracking. I'm looking at the data, and only about 60% of S&P 500 stocks are above their 200-day moving average right now.
Which is wild. At record highs, that number should historically be sitting around 73% or 75%.
And the advanced decline line has been trending lower since April. It's printing lower highs while the index prints higher highs.
Yeah, Bank of America's desk actually flagged that divergence today, warning it signals a summer correction.
Right, and Liz Ann Saunders at Charles Schwab noted the breadth is, quote, challenged. It's like a tug of war where only two huge guys are pulling the rope.
And the rest of the team just went to get hot dogs.
Yeah, exactly. But wait, let me push back for a second. If you look at the VIX, the fear gauge, it got absolutely crushed today.
Yeah, it dipped below 16.
Right, hitting a 4-month low of 15.73.
Yeah.
So if the VIX is at a 4-month low, isn't that a sign of safety? Why shouldn't we trust that?
Because a crushed VIX doesn't always mean safety. Right now, it signals dangerous complacency.
Because the geopolitical fear just sucked all the oxygen out of the room.
Precisely. Option premiums are incredibly cheap right now. So it's actually a highly attractive time to buy protection before the rot catches up to these top-heavy indexes.
Okay, speaking of top-heavy, let's talk about the heavy lifters versus the laggards, since this is obviously a stock picker's tape.
Oh, absolutely. And tech was the undisputed champion today.
You have to look at Snowflake, ticker SNOW. It went completely parabolic, surging like 38% to $238.37.
And a massive volume, too.
Yeah. 32 million shares traded today compared to a 30-day average of just 7 million.
I mean, they beat EPS 39 cents versus the 32 cents expected and raised guidance.
But the real catalyst was that massive $6 billion AWS infrastructure partnership.
Right, which just shows this massive re-rating for enterprise AI.
Yeah,
But then you look at the other side of the barbell.
Dollar Tree, ticker DLTR, it ripped nearly 18% to $113.12 today.
Beating EPS, $1.74 versus $1.55.
Right, and they expanded gross margins. Their multi-price strategy, the $1.25, $3, and $5 items, it's capturing middle to high-income consumers.
Consumers who are actively trading down just to survive the inflation we saw in this morning's data.
Right, and here's where it gets really interesting to me. Consumers are aggressively trading down at Dollar Tree to afford basics, but mega corporations are casually dropping $6 billion on cloud infrastructure with Snowflake.
It's the ultimate paradox. What does that say about the broader economy to you?
That it's completely fractured.
Exactly. It's the mechanical reality of a K-shaped environment. Enterprise tech is booming on an AI wave, while the everyday consumer is just pinching pennies.
The market isn't a single organism anymore. It's two completely different economies operating in parallel.
Which is exactly why the laggers got punished so hard today. Energy obviously dragged as oil dropped.
But even in tech, Zscaler ticker ZS suffered a brutal bearish breakdown today.
On 3 times average volume, because they gave slightly soft cash flow guidance.
Right. And Synopsys, ticker SNPS, dropped 9% on a classic good earnings, bad reaction, fade over restructuring costs.
The margin for error is just 0 right now.
So knowing that we have a fractured economy and a really fragile, top-heavy market, what does this mean for the listener heading into tomorrow's open?
Well, the S&P 500 is on a 6-day winning streak. Statistically, the probability of continuation tomorrow is very low, like under 40%.
Meaning a mean reversion or a cool-off is highly likely, especially since we saw dark pool distribution picking up today.
The smart money is quietly distributing into this momentum.
And that brings us to the options positioning. We have a massive gamma wall sitting at 745.50 on the SPY.
Right. And if we stay above that camel wall, dealers are basically suppressing volatility.
Because they're delta hedging, they buy the dips and sell the rips, right?
Exactly. So the upward grind just continues. But the critical level to watch is the trapdoor at structural support 738 on the SPY.
Because if we lose 738, that entire dealer positioning flips.
They flip into short gamma, they become forced sellers into a falling market, which just rapidly accelerates the downside.
So basically, we are essentially one bad headline away from the dealers, the guys pulling the levers behind the curtain, flipping from reliable buyers into forced sellers.
That is exactly the risk, which is why patience is the most important skill for tomorrow's tape. Don't chase the open out of FOMO.
Right. Wait for the morning washout. But we do have 2 specific day 2 setups from the notes to watch.
Yeah, first is Snowflake. It consolidated tightly this afternoon.
Yeah.
If SNOW can break its early resistance at $240, it could trigger a momentum squeeze toward $250.
As those late shorts are forced to cover. And the second day 2 play is Dollar Tree.
Right. If DLTR can hold the $112 level on the open, it establishes a structural floor, targeting that $120 liquidity pool.
Got it. So to wrap this up, the history books will show today, Thursday, May 28, 2026, as a day of fresh all-time highs.
Yeah, but you, the listener, now know the actual truth.
Right. It's a market running on fumes, narrow tech momentum, and a highly fragile geopolitical truce. Whether you're actively trading those day 2 plays or just watching your retirement account, understanding this underlying breadth protects you from the headline illusions.
And honestly, it leaves us with a really provocative thought to model out over the weekend.
What's that?
Well, if a mere unsigned draft of a 60-day ceasefire can trigger a massive market melt-up and crater oil in hours, what happens to this highly leveraged market if the deal falls apart before Monday?
Oh, wow. Yeah, that trapdoor at 738 would get tested immediately.
Exactly. And conversely, if the geopolitical risk vanishes completely, does that mean sticky 3.3% inflation suddenly becomes the only thing this overextended market has left to care about?
Man, that is the exact asymmetry we have to navigate right now. Thank you for joining us on this deep dive. Make sure you keep digging into those internals, stay disciplined, and stay curious.
See you out there?
We will catch you on the tape next time.